Welcome to the Deep Dive. We're jumping right in today with the source material you sent over, looking at AGNC Investment, ticker's AGNC.
Right, AGNC. And it's quite the situation the source lays out, isn't it? You've got a stock price dipping below $10 a share.
And because of that dip, the dividend yield has just soared. We're talking over 15%.
Over 15%, yeah. That's the kind of number that makes you stop and look, especially when you compare it to, say, the S&P 500 yield, which is, under 1.5%?
Exactly. It's a huge difference. So the big question is, what's really going on? Our mission here, using just the info from your source, is to kind of unpack this. Why the low price? Why the super high yield? And, is it an opportunity or maybe more of a warning sign?
Well, the source cuts pretty much straight to the chase on why the price is down. It puts the blame squarely on volatility. That's the main factor dragging the stock down this year.
Volatility. Okay. So not necessarily something fundamentally broken within AGNC itself, but more about how the choppy market waters are affecting it.
That seems to be the angle, yes. And the source actually points to a specific trigger for a spike in that volatility.
Oh, yeah. What was that?
It pulls a quote from the CEO, Peter Federico, on their Q1 earnings call. He mentioned that tariff policy announcement back in early April.
Ah, right. I remember that making waves.
Yeah, he said it caused volatility to increase significantly across all financial markets, and that included interest rates.
Okay, so a policy announcement shakes things up, creates instability, especially with rates. How does that ripple effect play out in AGNC's specific market, according to the CEO?
Well, his description, based on the source, sounds pretty intense. He talked about normal financial market correlations basically breaking down.
Things not moving together like they usually do.
Exactly. And liquidity dried up, got constrained, was his word, and investor sentiment just soured. And crucially, he said the agency MBS market, the mortgage-backed securities AGNC deals in.
Yeah, the government-backed ones.
Right. That market was not immune and felt significant pressure back then in early April.
So, okay, this wasn't just background noise. It actually hurt AGNC directly. What kind of impacts does the source mention?
It flags two key things. First, the value of their actual investment portfolio went down. Second, and this is important, their cost of capital went up.
Cost of capital rising. What were the numbers?
The source gives specifics. It was 16.7% in Q1, but jumped to nearly 18% early in Q2.
Nearly 18% cost of capital. Why is that specific number so critical for a company like AGNC? What does the source say about that?
It's absolutely central to their model, as the source explains it. AGNC borrows money. They use leverage to buy these mortgage assets. So to make money and, really importantly, to pay out that big dividend.
Yeah.
They need the return they earn on their investments to be higher than what it costs them to borrow the money. If that borrowing cost, the cost of capital, goes up to nearly 18%.
Then they need their investments to earn even more just to cover it and have something left for the dividend.
Yeah.
Okay, that makes sense. Higher borrowing costs squeeze the profit needed for payouts.
Precisely. So that explains some of the pressure, right? The stock price, the portfolio value. But the source does mention a positive side, too, even with these challenges.
Okay, what's the flip side?
Despite the portfolio value dip and the higher costs, the CEO apparently highlighted an offsetting trend. The source quotes the Q1 earnings release, where he said that anticipated portfolio returns have increased commensurately with today's wider spread environment.
Wider spread environment. So the gap between what they earn on assets and what they pay for funding got bigger. Potential earnings went up too.
That's the idea. And the CEO apparently put some numbers to it on the conference call, according to the source. He figured that in the current market, a portfolio like AGNC's, using leverage, could potentially generate a return somewhere in the low 20% range.
Low 20s, okay. And their cost of capital is near 18%. So this is where the source connects the dots on dividend safety, right? At least for now.
Yes, exactly. The source uses a CEO quote saying that because these go-forward returns still align very well with that total cost of capital right now.
That potential low 20s return is comfortably above the roughly 18% cost.
Right. So the interpretation presented in the source, based on that, is that the dividend looks safe in the current environment.
In the current environment. That feels like a really key phrase there. It sort of leads directly into the big risk the source flags, doesn't it? This alignment, it might not last.
That's the heart of the issue the source gets at. As long as returns are beating costs, the dividend's okay. But if returns dip below the cost of capital,
then what?
Then the source says the REIT might need to reduce its dividend. And it doesn't just speculate. It points out that AGNC has cut its dividend before. Several times, actually. It mentions looking at their dividend history chart.
So past cuts show it's definitely possible. While the current numbers look okay, that balance is fragile, what does the source say could, break that alignment? What could go wrong?
The main thing it highlights is the risk of market conditions changing sharply and without warning. It uses that same tariff example again.
Right, the thing that spiked volatility earlier.
Yeah, and it makes the point that while this time the disruption actually led to higher potential returns that matched the higher costs.
That might not happen next time.
Yeah.
The source says won't always be the case. Market reactions can be messy, unpredictable.
Exactly. And it also talks about the risk of a bigger, more systemic problem, a significant shock to the credit markets. Think back to the pandemic or the financial crisis.
Big disruptive events.
Right. In scenarios like that, the source warns AGNC's returns might just not keep up with its cost of capital, and that could cause it to cut its dividend.
So it's not just gradual shifts, but these sudden big jolts that pose a real threat to that dividend stream, which really underlines the source's advice that investors need to, constantly monitor things?
Absolutely. Because the factors driving that balance, volatility, rates, credit health, they can flip really fast. The source is clear. That impacts how safe that dividend payout really is.
Okay, so let's pull this together then. Based on everything in the source material, what's the final verdict on AGNC's business model?
The source sums it up pretty bluntly. It's a higher-risk business model.
And that stock price under $10, creating that massive yield, it doesn't make it an automatic buy for everyone looking for income.
No, definitely not. The source specifically says it's not necessarily a screaming buy for those seeking a big-time income stream if they don't grasp these underlying risks.
So who might it be for, according to the source, at these current levels?
It suggests it could appeal to risk-tolerant investors. People who understand the risks but see an opportunity to earn a high reward through that big monthly payout. The key words being risk-tolerant.
And on the other side, who should probably steer clear based on this analysis?
It says it's likely not a fit for those more risk-averse. Why? Because, and this phrase stands out, it doesn't provide the most bankable income stream.
Most bankable. That really captures it, doesn't it? After hearing about the volatility, the potential shocks, it's not bankable like something steady and predictable. Its reliability depends heavily on market conditions staying favorable, or at least manageable.
Exactly. That high yield number is tempting, but the source really emphasizes understanding the mechanics and the sensitivity to external factors underneath it.
So thinking about you, our listener, what does this look at AGNC, the volatility, the cost of capital dynamics, the potential returns versus the real risks mean when you're evaluating any high-yield opportunity?
I think it means you really have to look past just the yield percentage. You need to understand why the yield is so high. Is it because of risks, like the ones the source details for AGNC? How sensitive is that payout to things outside the company's control?
Right. So wrapping up our deep dive into this source material, AGNC's impressive over 15% yield is presented as being tightly linked to significant volatility risk. There's potential for future dividend cuts if market conditions sour and those crucial returns fall short of the cost of capital.
Which leaves us with a final thought. Maybe. Given that even these potentially high current returns don't fully guarantee the dividend against unpredictable shocks, what does it really mean for an income stream to be bankable? And how do you personally weigh the allure of that high reward against what the source calls the need to constantly monitor the underlying risks? That's something to consider with any investment offering a really high yield.